Hello and welcome. We've put together this guide with the experts at My Tax Accountant to walk you through one of the most powerful yet often misunderstood tax reliefs for UK investors. We're talking about EIS Loss Relief.
Right, let's just jump straight in with a big question. Imagine this. You put £10,000 into an exciting UK startup. It's high risk, and it fails. Completely. All your shares are worthless. But what if your actual out-of-pocket loss was less than £4,000? Sounds a bit too good to be true, doesn't it? Well, it's not. It's a real government-backed system, and we're about to show you exactly how it works. So here's what we're going to cover. We'll start with the safety net itself. Then we'll get into how to calculate what your real loss is. We'll look at the two different ways you can claim relief, walk through a real-life example, Aisha's story, and then cover the nuts and bolts of how you actually make your claim, and finally where to get expert help.
Okay, let's get into it. First things first, to understand the loss relief, you've got to understand the scheme that makes it all possible. And that's the Enterprise Investment Scheme, or EIS for short. So, what is EIS? Put simply, it's the government's way of saying, hey, we need people to invest in our small, innovative, but risky companies. You know, the ones that could be the next big thing. To make that risk a bit more palatable, they offer a whole package of really attractive tax breaks to investors like you. Now, EIS has a few great perks, but the one we're really focusing on today is what happens when things go south. And let's be honest, with startups, that can happen. That's where loss relief comes in. Think of it as a government-backed safety net for your investment capital. Now, this is where it gets really clever. Your loss, for tax purposes, isn't actually the full amount of money you handed over. It's all about a little thing called your effective cost. So how do you work this out? It's simple. You take your initial investment, and then you immediately subtract the 30% income tax relief that you get up front just for making an EIS investment. What's left is your effective cost. This is the figure that your loss is actually calculated on. It's a brilliant way to reduce your risk from day one. Let's put a number on that to make it super clear. You invest £10,000. Straight away, you can claim £3,000 back against your income tax bill. So the amount of your own money that's actually at risk, your effective cost, is only £7,000. Before we even get to loss relief, your potential loss is already capped at £7,000. Okay, so you know your effective loss. What now? Well, you have a choice to make. There are two different paths you can take to claim your relief, and choosing the right one for your circumstances is absolutely key. You can either set the loss against your income tax bill or against a capital gains tax bill. Which one is better? Well, it really depends on you. Do you have a big income tax bill from your job? Or maybe you've sold a second property or some other shares and have a capital gains bill to pay. Your personal situation dictates the best route. Now, claiming against your income is usually the go-to option for most people. And why is that? It's simple, really. The relief you get is at your marginal income tax rate. That's the highest rate you pay, which for many people is 40 or even 45%. Since those rates are often higher than capital gains tax rates, it just means you get more cash back from HMRC. I know, that was a lot of theory, so let's make this real. We're going to follow the story of Aisha, a freelance designer based in London. Stay with me here, because when you see how the numbers play out for her, you'll really understand just how powerful this relief is. So, meet Aisha. She's a successful freelancer, and she's an additional rate taxpayer, so she pays tax at 45%. She's done well and decides to invest £50,000 into a promising local tech startup that qualifies for EIS. Right off the bat, because it's an EIS investment, she claims her 30% upfront relief. 30% of £50,000 is £15,000. So that's a £15,000 reduction on her tax bill for the year, just like that. This means her actual exposure, her effective cost in this venture, is down to £35,000 from the get-go. So a couple of years go by, and unfortunately, the startup doesn't make it. The company folds, and Aisha's shares are now worth zero. But remember, her loss for tax purposes isn't the $50,000 she invested. It's that effective cost of $35,000. And now, it's time for her to claim her loss relief. And here it is, the moment of truth. Let's break this down. Aisha's effective loss is £35,000. She chooses option 1 to offset it against her income. Because she's a 45% taxpayer, she gets to claim 45% of that $35,000 loss back.
That works out to another $15,750 in tax relief. Now add that to the $15,000 she got up front. Her total tax relief is a massive $30,750. So her net loss on a $50,000 investment that went to zero is just $19,250. Just think about that. She lost less than 40% of her initial investment. That is the safety net in action.
Okay, seeing those numbers is pretty amazing, but that's not all. Here's where most people go wrong. You have to actually claim it, and you have to do it correctly. So let's look at the practical steps you need to take.
The whole process is handled through your self-assessment tax return. You absolutely need your EIS-3 certificate. That's the proof. The main form you'll be dealing with is the SA 108, which is the capital gains part of your tax return. This is where you declare the loss. Here's a quick insider tip. It's so easy to miss the box where you have to specify if you're claiming against income or capital gains. A tiny mistake like that can cause major delays, so attention to detail is everything here.
And here's another fantastic pro tip from the team at My Tax Accountant. You don't always have to wait for the company to be officially wound up. If the shares have become pretty much worthless, you can make what's called a negligible value claim to HMRC. This basically lets you pretend you've sold the shares for zero, crystallizing the loss and allowing you to claim that relief much, much sooner. It's a real game changer.
So as you can see, the benefits are huge. But let's be honest, the rules can get a bit tricky. Getting it wrong could be costly, which is exactly why getting some professional guidance is so important. Now, before we wrap up, a very important disclaimer. Everything we've talked about today is for general guidance and is based on the tax rules for the 2025/26 tax year. You absolutely should not rely on this alone to make financial decisions. Tax rules can change, and your own personal circumstances will always determine what benefits you can actually get. The number one takeaway here should be that before you do anything, you should always consult a professional. The experts like the team at My Tax Accountant live and breathe this stuff. They can make sure you're taking full advantage of reliefs like this while making sure everything is done by the book. If you want personalized advice on EIS loss relief, or really any other tax matters, you should get in touch with the team at My Tax Accountant. You can give them a call on +8 020 570 8531 or drop them an email at info@mytaxaccountant.co.uk. For a deeper dive, you can also read the full article on their blog and, of course, subscribe to their YouTube channel for more great guides like this one. So we'll leave you with one final thought to mull over. Now that you know about this incredible safety net, a system deliberately designed to de-risk investing, how does it change the way you think about backing the next generation of innovative UK companies?